It's another Friday in Finance here at Brookstone Financial. Today I want to talk to you about a very timely opportunity. Actually, an opportunity you only have 24 days left until the end of the year to take advantage of. Now, last week we talked about Roth conversions, how to create a bucket of tax-free retirement income. Now think about this, folks. The best time to shop is when things are on sale. Historically speaking, tax rates currently are on sale, especially with the recent tax cuts. So what better time to consider paying taxes on your tax-deferred money than when taxes are on sale? I want to go back first of all to the example I used last week about a basic Roth conversion strategy, and then I want to show you that Roth conversion strategy on steroids. Last week we talked about an individual that came into the office. We realized that their earned income or adjusted gross income was somewhere in the $57,000 range. That's the first tier of this block here. So if I sit down with someone and I see that their income is, say, roughly $57,000, then in that year I might suggest that they convert $20,000 to Roth because they're simply maximizing the tax bracket that they're already in. So the top of the 12% federal tax bracket currently is just over $77,000. So why not go ahead and maximize that tax bracket? Really, the only way you lose in that strategy is if taxes continue to go down in the future. Now, folks, we've got $20 trillion plus worth of debt. So the likelihood of that happening is slim to none. Now, the ideal opportunity for taking advantage of a Roth conversion strategy, in most cases, is the time in which you retire to the time in which you turn 70 and a half. And why do we say 70 and a half? Because at age 70 and a half, you're going to be forced into taking what's called required minimum distributions. Those are forced distributions from all your pre-tax accounts, your IRAs, 401ks, maybe even 403bs. So whether you need the money or not, Uncle Sam needs the tax dollars. Now, those forced distributions, when you turn 70 and a half, may have an impact on the taxation of your Social Security, therefore causing more of your Social Security benefit to be taxed, therefore causing you to pay unnecessary taxes. So how can we start to control the amount of our required minimum distribution? Well, the opportunity, again, is the time in which you retire till you turn age 70 and a half. And what typically happens during that time period is your income levels typically fall. So that's a great window to take advantage of a Roth conversion strategy. In this scenario, we're going to assume we have an individual age 66. So between the ages of 66 to 70, that's our 4-year window of conversion. Now, assuming that this is their income, they're at roughly $57,000 per year during that period, we're going to look to convert $20,000 per year or $80,000 over the period. Here's what we might consider doing. First of all, we're going to take $80,000 of the IRA and we're going to peel it or divide it into 4 individual sub-IRAs at $20,000 apiece. Now again, this is a Roth conversion strategy on steroids. In that year or the current year, we're going to go ahead and declare a Roth conversion on all 4 of those pieces. So on the front end, it looks like we're converting $80,000 of IRA money, which therefore would cause an additional $80,000 of taxable income. Well, keep in mind, we're only looking for 20, okay? So we're going to declare the conversion on all 4 of those sub-IRAs on the front end, $20,000 apiece, equaling $80,000. 1 year later, and we're going to take a different investment strategy with each one. Some we're going to be aggressive, some we're going to be conservative for a particular reason. So this strategy here, let's say this IRA a year later, the $20,000 is now worth $18,000. It didn't fare so well. The market turned down, we were aggressive, and it didn't play out so well. Strategy number 2, let's say it did fare. A year later, it's worth $21,000. Strategy 3, though, was a home run. It's worth $24,000 a year later. And strategy 4, we're going to say it didn't fare too well, and now it's at $19,000. Now, remember when you were a kid and you're playing with your best friend or your sibling, right? Something doesn't go your way, and you call a do-over. We're going to call a do-over with the IRS. Because when we look at these 4 IRAs that, again, on the front end, we have declared a Roth conversion. We're going to go back to the IRS a year later and say, you know what, it doesn't make sense for me to pay taxes on $20,000 when the account is now only worth $18,000. Because what you have to keep in mind is the taxes or the tax liability is based upon the account value, the date of the conversion. Well, the date of our conversion, every one of these was $20,000. So why would I pay taxes on $20,000 when my account's now worth $18,000? So you know what I'm going to tell Uncle Sam? I want a do-over with that one. I don't want to accept that. I want to recharacterize that conversion, okay? It's as if nothing ever happened from a tax standpoint. IRA number 2, you know what? That one didn't do so bad, but you know, I think there's a better choice here, which is IRA number 3. So this one we're going to recharacterize and declare a do-over with the IRS. This one here obviously is a loser, so we're going to recharacterize that one as well. This one is our winner. This is the strategy we're going to keep. Now folks, we're going to employ this strategy each and every year until we get all $80,000 converted to tax-free retirement income. If you want more information about Roth conversion strategies, and again, a Roth conversion strategy on steroids, come in and see us at Brookstone Financial. We offer absolutely complimentary consultations. Our toll-free number is 866-945-3220, or you can go to our website at brookstonefinancial.com. Now, as a special offer, everyone that comes in for that complimentary consultation will get a copy of my new book, Innovations in Retirement Planning: How to Get More Out of What You've Got. We'll see you next week here at Brookstone Financial.